Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Protect and Grow with Chicagoland certified financial planner Tim Stearns of TJ Stearns Incorporated. Trust, respect, and results. TJ Stearns Incorporated focuses on comprehensive financial planning and benefits.
And welcome into the program. This is Protect and Grow Chicagoland Retirement with Chicagoland's certified financial planning professional, Tim Stearns, CFP, president and founder of TJ Stearns, Inc., your resource, ladies and gentlemen, for a common sense approach to planning, for information, for guidance and perspective on what we need to be doing with our money in order to achieve our important financial goals. And I think, Tim, that people are looking for that reliable resource now more than ever before. It's so hard to sort through the noise. And at the end of the day, we all just want guidance on what to do with our money that is in our best interest. And sometimes that is hard to find.
I agree, Peter. And these are tough times right now. People are very worried. I don't want to use the word panicked because I think that's a little strong, but they're definitely worrying about the market and, kind of what the future looks like. So they're taking kind of a step back, giving pause to, after a 13-year bull market that you're used to the market just going up and doing its thing, or if it's down a little, it's down very little. So now it's kind of a reality check for people. So,
well, if you have questions or concerns about your money, ladies and gentlemen, I always want to remind you as we get going on the program that Tim Stearns does make his time available, his guidance, his perspective as an experienced, qualified planning professional. He is a certified financial planning professional. Tim Stearns, CFP, makes the time available to you to have a phone conversation, have a few direct questions answered, or to look over the comprehensive plan, your investments and retirement accounts, and make sure everything's working together to help you achieve your important financial goals. If you'd like to take him up on that offer for the conversation or the consultation, pick up the phone and give a call. 800-640-2256. That's 800-640-2256. Tim, one of the reasons I think that we are finding it so difficult to find reliable advice is that there seems to be so much conflicting information out there. On one hand, we've got talking heads saying that we're going to bounce back and don't worry, everything's actually fine. And then on the other hand, we've got people saying, hey, this is going to be just the beginning of the tip of the iceberg of the end being near. And it's like those on any topic, not just where the market may head here short term, but on almost any financial topic basis, there's polar opposites screaming their opinions. And it's hard to sort through and take with a grain of salt what we actually need to hear and what applies to our situation.
We can't tell the future either here, but we will say this, basically when the Fed is tightening money like they've been doing, which is raising interest rates, that doesn't usually bode well for the stock market. So it's kind of a reality check, like we just said, but more importantly, you kind of know it's going to continue. The Fed, the Federal Reserve governors, and the Federal Reserve Chairman, Jerome Powell, has said that they're going to do that probably through the end of this year into next year. So if you know that's going to happen, that does not bode well for most stocks. So you need to be very, very careful about what you're purchasing. And, do you have stop losses? The days of making easy money in the market, I think, are over for the time being, at least. I know a lot of people out there thought they were, savants that were great at money management, but it turns out, it was easy money and easy come, easy go now. So we have to be careful and kind of double down on what we're doing and go back to the basics and make sure that you have an income plan, you have stop losses, you have non-correlated assets. I see people come into our office or they talk to me in our retirement classes. Everything's correlated. They have stocks, bonds. It doesn't matter what they have, or they have stocks and bonds in their mutual funds. They might have a little dose of commodities and a little bit of cash, but for the most part, they're they're pretty tied to things that are not guaranteed and are volatile and are not correlated.
And Tim, you ultimately offer your professional services in helping people create and craft the plan and then implement the plan and manage the plan on an ongoing basis on a specific individual level. But when we watch the news or read the newsletters or look on the internet for information, we have to understand that when there's not a specific product being sold, then I've been told this, I've heard this, and it really resonated. If there's not a product, then you are the product. And so one of the reasons why the news is so polarizing and always has sensational headlines is because they need to keep viewership to sell advertisements to the advertisers. And therefore, we are the product. They're trying to keep us enthralled and entertained and tuned in. And that's why there is such division and such sensationalism within the news that we really need to take with, look at with some jaded glasses, quite frankly.
It's funny you bring that up because I was just telling a client the other day that, they keep talking about a recession. And I feel like it's, shock and awe, with the news every day, and then it's going to become a self-fulfilling prophecy, right? Oh, we're going to have a recession. We're going to have a recession. And next thing you know, we're in a recession, and no one's, everyone's talking to the worst of what's going on in the world. And that's too bad because we need to get out of our own heads and go back to the basics and understand what you own. What I tell people in our class, what do you own? Why do I own it? And when is that going to change? And a lot of people, we had a gentleman in here, he's retired 8 years off of police force. He's buying and selling stocks. And he's like, I can't make any money anymore. And the truth of the matter is those days are over for the time being. So he needs to be much more careful. And so do all of us about what we're going to put money in. Things that are losing value left and right are things that usually don't have good fundamentals, and they were going up real quick and going down real quick, and you can play that game for a bit. But what if you get caught in the down game? And that stinks.
Well, you mentioned not knowing the future, Tim, and I think that we all need to readily admit that, but oftentimes those talking heads, what I hear is them basically forecasting the future on what has happened in the past. Right. When another inherent conflict in the financial world, the standard statement and language is always future performance is not guaranteed, or past performance cannot guarantee future results. Right. And so saying, well, the market has always gone up over time. Well, the market has always come back. Well, the market has averaged 8 or 10 or 12% over time does not mean that it's going to continue to exemplify that behavior into the future. And yet a lot of plans are based on essentially the past repeating. And that's how we can kind of predict our financial future. I know that it's been said that history does not repeat, but it often rhymes. And I think that this current scenario that we're in with inflation and rising interest rates and a challenging stock market does feel very reminiscent of the late 1970s, early 1980s. But we have to understand that history does not always repeat. And yet, the financial conflict here, Tim, is that a lot of people's plans are based on history playing out consistently into the future.
Well, a slide we show in our retirement classes is from 1980 to 1999. And what it shows is a straight curve to the right-hand corner showing that the market basically went up all those years. And we talk about that as being your grandfather's stock market. Those were the good days. Well, 2000 through 2022 have been the W, 2 steps up, 1 step backwards, 3 steps up, 4 steps backwards. So we have to adjust with, the new reality that, things might be a little bit rougher for a while. And what have you done to protect yourself? If you're just letting yourself play this game of, the market's going to come back. Well, what if it doesn't for quite a while and you're in retirement and you are a net seller of assets because you don't have a pension? So you have a 401k that you're taking money out of and you're locking in those losses because you need to pay your bills. Well, that's something that we can help people with by having an income allocation plan. That is not something that our clients are worried about. We also don't have a lot of clients calling in right now sweating the stock market because they know that we've got an income allocation plan that takes into account that.
Dynamic and tactical, the way that TJ Stearns Inc. handles the investments, ladies and gentlemen. And that is another, I believe, Tim, inherent conflict in the financial world. So often we are told, buy and hold, stick with it for the long haul, just stay invested. And yet, if you look inside of most mutual funds, they themselves are not taking their own advice. There's something called an internal turnover ratio, where the holdings inside of a mutual fund may have an internal turnover ratio of 50%, 100%, 200%. That is the amount that they themselves are buying and selling and transacting within any given year. They're telling you to buy and hold, ladies and gentlemen, but they are internally doing just the opposite. And Tim, why we as individuals probably need to rethink a more active and tactical strategy like what you subscribe to there at TJ Stearns Inc.
And that's half the battle, is to get people off this old nuance that, the market's going to buy and hold. You buy and hold, and it's going to come back eventually. Why? We were with one guy the other day, and he was told by his advisor, who, by the way, had 5 years on the job. So the guy has never seen a bear market. All right. So he's got 5 years on the job. He's telling him, hey, your portfolio is worth 1.6 million. It was worth 1.6 million at the beginning of the year. It is going to go, it's down to 1.3. In the next 4 months, it's going to go down to $1.1 million. But by the end of the year, it'll be back to 1.6. I don't understand that. I don't understand that. Why would you stick around to watch the carnage when you should be getting out? And there's going to be algorithms that tell you that. But these companies, the one company that this gentleman is with is, their technology is from 1979. I was 7 years old then. So you look at that and things have to change, and if you don't change, guess what? The market's going to teach you a hard lesson.
Well, and Tim, if you are so certain of that, if you somehow do have that ability to predict the future and you believe that it's going to go down to the 1.1 million, why not sell out at 1.3, wait till it would have been 1.1, buy back in and let it go back up above the 1.6? The truth is that nobody knows. You cannot predict that. You just have to have a plan set up for a long-term time horizon with those kind of contingencies that you can pivot as economic conditions and life conditions change. And if that's the type of plan that you would like, ladies and gentlemen, with more ongoing tactical, hands-on management and guidance, as well as a resource that you can talk to and ask questions of and get information from and consult with on an ongoing basis, pick up the phone and give Tim Stearns CFP a call, 800-640-2256. That's 800-640-2256, 800-640-2256. Tim, this next one on your list of inherent conflicts in the financial world, I love this one because it's always sort of bugged me, is that when financial recommendations are given, it's the standard disclaimer language of this is not tax or legal advice. And if you want tax or legal advice, you should consult a tax or legal professional. However, every financial move has tax consequences. So if we're making financial recommendations, how in the world is it that we are not de facto, in fact, making both tax and legal advice as well?
Well, I would ask that person that's giving you the advice, do you have a CPA on staff? Do you have an accountant that can help tell me whether this is right or wrong? The good answer for us is yes, we do. Joe gives us, any information that we need and make sure that the client's involved in that so that we know what are the ramifications to them. Which brings up a great opportunity that we have right now, which, as you know, are Roth conversions. As they say, taxes are on sale, right? They're the lowest they've been in over 60 years. They sunset in 2025. So now what? If your advisor has not talked to you about doing some Roth conversions, now is the time, before they start raising income tax rates, which they have said they're going to do. They just got to get out of their own way to do it. But when they do it, it's, what is it going to look like? The 10% will go back to 12, 12 will go back to 15, 15 goes back to 18, and so on and so forth. Who wants to do that? So if you can take some of that money and start to convert it, and I'm just saying to nibble on the tax bill so that, you don't leave your family with a huge tax time bomb, we call it over here. Basically, that you're going to have to pay taxes that, the government's never tapped into. With the Secure Act, that's a real problem. The class we just taught last week, neither class in my teaching knew of the Secure Act, not even a little bit. And please, for the listeners out there, go look up the Secure Act and what that could do to your portfolio if you're not here.
Tim, we've talked about the Secure Act before. We've talked about how the current law on the books is a de facto tax increase in just a few short years in 2026. But as you were giving that explanation, it had really never struck me before. The 12% bracket going up to the 15% tax rate, that is a 25% tax increase that we could avoid today by taking advantage of this opportunity, right? And I think that anybody that chooses to ignore, defer, and delay making the decision on taxes is doing themselves a big disservice to it, not at least have that conversation if you could avoid a potential 25% increase on the taxes that you would ultimately pay on your IRA and tax deferred dollars.
I'll ask you right back, though, after you just said all that. If you know something's going to be more expensive next year, why would you wait?
When your dollars are worth less
exactly, especially, and we haven't even tackled inflation today, right? So exactly. So you have, that. One other thing I want to back up to that we kind of, I forgot to mention, this other person that I talked to was with the same company, another person, and they were talking about how they had projected out an average return, and that stuff's not worth the paper it's written on, or typed out on. A projection. Have you ever seen a stock market go up 6% every year, no matter what, or 8% or 10%? Name your number. It never consistently goes up a certain number. And the Department of Labor states that if you're going to do an income allocation plan, 6% is aggressive, 5% is moderate, and 4% is conservative for retirement planning.
And to put that in perspective, Tim, a lot of people are assuming a growth rate of maybe 8 or 9 10 or 12%. And your numbers, they're not unrealistic. In fact, the annualized compound rate of return of the S&P from the beginning of 2000 till today, so 22 and a half, 23 years of history, has only been a little over 4.75%, right? Not even a 5% annualized rate of return. If you're assuming 10 and you only get 5 for the next 10 or 20 years, how far off your trajectory, your intended destination, Tim, does that put you?
Well, if you're assuming that, you're assuming you're going to have money that you're not going to have.
Exactly.
And the other thing I have a problem with is this saying that it's going to go up each year that amount. That's not going to happen. And nothing. I mean, think of does your job every day is exactly the same? No, nothing's the same every day, year in and year out. Things change by the minute. So you can't rely on those types of numbers.
Tim, I heard a funny story once that the Army, in its wisdom, decided that it would just order uniforms in the size of the average soldier. And you know what ended up happening? Those uniforms didn't end up fitting anyone. And the analogy here is that relying on average rates of return generally just never fit and never work out exactly the way that we intend to.
So you go with those averages. We literally have a slide from our class that shows what the average is versus what the actual return was, when you put it onto paper. So, I mean, the numbers are completely different. So you need to make sure that when you're doing an income allocation plan, if you haven't done one, if this isn't a wake up call right now where you lost, 20% of your money so far this year, this is the time that you want to get, make sure, to shut the barn doors because the horses are starting to get out. That's something I think is really important. It's never too late to plan, and yes, I remember my professor at DePaul University when I got my certified financial planning certificate. He said, "Do you know what most bull markets die from?" And I said, "No, what?" He said, "From euphoria." And that's absolutely true. At the end of 2021, everyone and their sister thought, "Oh my gosh, it's never going to end. The party's just going to continue." Well, guess what, guys? It has. So now you have to be a little more careful about where we're putting our money. Do you have stop losses? Do you have all correlated assets? Give us a call and we can help with that.
Yeah. Again, the number, ladies and gentlemen, 800-640-2256 to reach TJ Stearns Inc., Tim Stearns CFP. No cost, no obligation. You can have a conversation. You can request a consultation and get that review, analysis, and strategy session with no cost to you. Get a plan put together and in writing from a certified financial planning professional, Tim Stearns, CFP. Just call 800-640-2256. That's 800-640-2256. Tim, another inherent conflict in the financial world, and I think one of the reasons why people are often confused and don't know where to turn for good advice is costs and compensation. And we know that there are costs. We understand that investing in a mutual fund has some costs. Consulting an advisor will eventually have some costs if we employ them to help us in their services. However, so often I think that the conversation about costs is obfuscated and intentionally misleading. And that's why people are confused about what they're paying for their money and their advice and their guidance. And that is, I think, problematic as much as anything in the financial world.
Well, and I agree with that. So one of the pillars of the 6 that we talk about in our classes is fees. What are you paying in fees? So a lot of times you'll have someone go, "Well, I'm only paying 1% to my person, my advisor." Well, if you're in mutual funds, guess what? The mutual fund manager does not work for free. Inside of that fund, there's also transaction costs, right? So you have to go on Morningstar to find out what that is, and it's different every year to year. Back to your turnover ratios, that all adds up. So there's 3 components. You have the advisor's fee, you have a mutual fund fee, and you have transaction costs. And you add all that up and you can start to see where you're at. That's why a lot of people think, well, my 401k is free. No, there's no free lunch, as my dad used to say. You're paying for it in some fashion. So, that's why I tell people, look at what you're paying in fees. You want to do an x-ray of it, come in and see us and we'll show you exactly what you're paying.
Just as an example, Tim, there's a very prevalent commercial that seems to air all the time. And the language goes something along the lines of, at other firms, advisors make money whether your account goes up or down, but at our firm, we only do better if you do better. And it's misleading in that it attempts to create a false distinction that just is not there. It
Right.
sounds like that's a different model, but in fact, that's the exact same model, the account moving up or down. They only make more money if your account goes up, but they're still making a percent of the account balance, whether it goes up, down, or sideways. And if they're misleading you intentionally in the initial advertising of their services, you got to really question what goes on from an ethical and moral standpoint behind the scenes.
Right. And that very company gives a lot of advisors a bad name. They're a buy and hold shop too. They're not doing a lot of trading. The person that I met with had over $4 million. And during the month of March and April, he had 8 trades being done, 8 trades while the market was going to heck in a handbasket. So, they're not earning their money. And one of the terms that we talk about in our class, and people should be cognizant of this, look up reverse churning. Reverse churning is simply taking a fee and not doing anything to manage your money. Versus churning in the 90s was buying a stock to buy, selling a stock to buy another stock and making a round trip commission for a stockbroker. Well, now the new thing is being an actual advisor and taking a fee per year and not really doing anything of money management that's worthwhile for the client. That's
I know one of the pillars at TJ Stearns Inc. is that everybody has the ability and everybody deserves the right to feel confident about what's going on with their money, and they can, so long as they're provided with proper guidance and education. That's your mission there at TJ Stearns Inc. Ladies and gentlemen, if you would like to have that confidence, if you would like to double check your current plan or get a plan put together that addresses income, investments, taxes, healthcare, and legacy, and many opportunities and subcategories within each one of those major topics of financial and retirement planning, pick up the phone, give Tim Stearns CFP and TJ Stearns Inc. a call, 800-640-2256. That's 800-640-2256, 800-640-2256. As always, the first 10 callers with at least $500,000 saved for retirement, you will receive a copy of the book, Income Allocation, the Essential Retirement Planning Strategy Guidebook, outlining the risks that we face most often in retirement and how specifically to address them. So pick up the phone and give a call now. 800-640-2256. That's 800-640-2256. Tim, always a pleasure. We appreciate your time, the guidance, the information, and the expertise that you provide to Chicagoland area savers and investors.
It's my pleasure, Peter. Thank you.
Tune into Chicagoland certified financial planner Tim Stearns' full radio program on 890 WLS every Sunday at 11 a.m. and visit tjstearns.com for many valuable resources, including other great episodes of Chicagoland Retirement. Be sure to subscribe.
Securities offered through TJ Stearns, a registered representative of Crown Capital Securities LP, member FINRA SIPC. The information presented on this program is provided for informational purposes only without warranty of accuracy, completeness, or suitability for particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature, not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs.